Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at Twitter, look at some information. We're going to talk about oil a little bit and some other things that I'm seeing in the markets, given what Twitter's posting. I'm going to give you my financial opinions around it. And again, if you guys need any help with anything, definitely check out finding-value.com. Platinum membership, use the word discount in the coupon code, get yourself a discount, try it out, join our community, have some fun, and we've got a 5 p.m. Mountain Standard Time on Sunday Platinum question and answer session coming up that we do through a Zoom call. Let's dive in. Again, if you want to follow me, it's at finding_finance. And the first thing I want to talk about is oil supply problems coming soon as U.S. shale oil production in the Permian Basin peaks. This is big news, guys. We don't know. We need more barrels of oil to come on to keep production flat around the world, to keep it flat. Every single year, we're losing 8 to 10 million barrels per day of production. That means every single year, we need to find a new Saudi Arabia of oil to stay flat. Now, I opened up this article, just wanted to touch on some things. It says, frackers are hitting fewer big gushers in the Permian Basin, America's busiest oil patch. The latest sign they have drained their catalog of good wells. Shale companies' biggest and best wells are producing less oil, according to the data reviewed by the Wall Street Journal. It says the Journal reported last year companies would exhaust their best U.S. inventory in a handful of years if they resume the breakneck drilling pace of pre-pandemic times. Now, if we come on it, and it just says the Permian spread across these areas is mimicking the onset of a production plateau that has taken place at other more mature U.S. shale plays. So the Permian could be coming to a plateau here shortly, according to the article. One of the quotes I wanted to talk about, it says, the world is going back to a world that we had in the 1970s and the 1980s, said ConocoPhillips chief executive Ryan Lance. Oil production from the best 10% of wells drilled in the Delaware portion of the Permian was 15% lower last year on average than top 2017 wells, according to the data from analytics firm Flow Partners. So we're not getting the flow rates out of shale like we have in the past. And I've talked about that before. It's not the cost of everything. It's a flow rate problem. So we can obviously prices are going to have to go up. They're going to have to spur more production, but it's a flow rate problem. Coming on down, it says oil production in the U.S. rose from about 7.2 million barrels a day a decade ago to a high of about 13 million barrels a day before the pandemic. But domestic output last year grew at 1/3 of the annual average pace seen in shale's heyday from 2017 to 2019 and hasn't yet caught up with pre-pandemic levels. So the growth is slowing, and eventually we're going to plateau where the growth is non-existent. Coming on down, one thing I wanted to talk about down here, it was down here. Let me see if I can find it. All right. Chevron executive said last week the company missed its oil production target in the Delaware, citing higher than expected depletion rates. The company's plans to revise its approach in the Permian, they said, shifting some drilling into New Mexico and targeting areas that are likely more productive. Moves that will reduce its pace of activity somewhat. Here's the problem, though. They're high grading everything. They're hitting everything that is productive today. That means in the future, though, the wells that are left are lower tiered areas. So that's what we've got there in the U.S. shale area. So I wanted to touch on that. Looking forward, we're going to have, here, I'll come in here. We're going to have a butting of heads here. We're going to have a butting of heads where we're going to see potential peak in oil production rates or in flows versus the slowing down of, we'll say, the money and credit coming into the system. They're going to butt heads here at any second. So that's what's coming. It's the butting heads of those two things. So here's Grady. He says the commodities currency AUD, which is Australian dollar, has an interesting setup. Posted on the blue back test. So this is the Australian dollar. It says now it has a possible pink inverse head and shoulders with parallel dash neckline, plus orange symmetry. So what we're doing is we're basically scribing out a lot of these big patterns. We've scribed out the shoulder. The head was created in 2020. And now we're putting out other types of patterns that just take time. So they basically started in 2021. We've been scribing out some of these patterns depending on what sector you're looking at, and they just take time. We're doing that in oil. We're doing it in the oil companies. We're doing it in natural gas. We're doing it in uranium. We're doing it in all these different areas. And everyone's like, is the commodity super cycle still here? It's like, it is, guys. These patterns that are scribing out are from such a big picture view that when this thing does come, it's going to be awesome if you're in these investments. It's going to be absolutely horrible for anyone that's not in them because it's going to be very inflationary. So what I do is I try to buy these bottoms wherever I can, and I just sit in it, and I don't do anything. It's that easy. Now, if we get weakness in the markets and we get a pullback, well, that's, so be it. I'm going to ride through it. But these patterns are scribing out. They're going to take some time. You just have to be patient. This is on a much longer, big picture view. Here's Eric. Eric says, everything I'm seeing makes me want to be long as much Canadian. I think that's crude select or whatever they have up in Canada, Western Canada select or whatever it is, as possible. Long life reserves, low declines, 20-30% free cash flow yields, 75 to 100% return on capital. Pathways equal ESG, box checked. TMX line fill, Q4 equals excess takeaway. U.S. shale faltering. We just went over the U.S. shale is faltering, and a multi-year bull market for oil. And I hate to say it, but I pretty much agree wholeheartedly with what he just said there. Canada's got a lot of really good companies up there with a lot of reserves with low decline rates. Perfect. I'll take them. I'll take all of them. And I've kind of combed through a lot of them. There's a couple that are my favorites. And I've kind of loaded up in those and are just sitting in them. They can also increase production out in the future. They are low decline. They're smaller companies, and they've got a lot of upside potential, which I like. And I talked about this one yesterday here. Here's also something that I wanted to touch on. It says, hi, Andy, could you share your experience and talk about the spinoff? It has happened recently in CTRM and would like to know your opinion. Thanks a lot. Yeah, Castor spun off its oil tankers. It's a company called Toro, ticker symbol TORO. I did read through recently their 10K that they released, and Toro does look like they are going to dilute shareholders to raise money. So would you want to be in a company that is diluting shares? I would say probably not. And it probably will have an impact to the price of the shares. So that is one thing I did read. I wanted to give myself some time to read through it. It does look like they are going to dilute shareholders. And in my opinion, that's not very good if you're a Toro shareholder. That doesn't impact Castor. It doesn't impact Castor. Castor would actually, they did very well Q4. If you check out their Q4 earnings, they did earn more money. They did very well. And I think Castor is great. This spinoff of Toro might be rough for shareholders, especially here in the beginning, because they said that they would do that fairly soon if they see the opportunities there to expand the business. So that's my take on it. And that's something that is not supposed to be meant as advice or anything like that. That's just my opinion on it and what I've read from the information that they released. Yeah, and here's something else that I've been seeing in the markets here is we've got a fairly optimistic forecast of hydrogen fuel cell future this decade, powered by no other platinum. Looking at you, South Africa. And, when I look at this stuff, if oil gets into, a problem and prices start to rocket higher, I do think there's going to be a large incentive to look for alternatives. And with the energy density that is needed to move large, heavy items like big trucks and planes and buses and stuff like that, I do think hydrogen could potentially work. I wouldn't say hydrogen is a great solution yet, because it takes a lot of energy to make hydrogen. It takes well-fitted materials and weld joints and everything else to contain hydrogen. Hydrogen is the smallest molecule in the world, and when we would perform braze joints and weld joints, we would check it with helium. And we have a helium leak check machine. We'd have it on the bottom. You'd put whatever part on top. It would pull a vacuum down, and then you'd spray helium on top of it to see if you could detect any helium through whatever joints you made. Hydrogen's even smaller than helium. So it's very difficult to contain hydrogen because everything has to be hydrogen tight. Otherwise, it just leaks out of everything. So that is a downfall, and it takes a lot of energy to create hydrogen, especially the hydrogen how they want to create it, which is basically through electrolysis. So, I do think that people are going to be looking for potential solutions, especially if oil and natural gas and some of these more, I'll say, more original sources of energy become a lot more expensive. And if people kind of get scared, I think this stuff will definitely fire up, and we'll start seeing more solutions with hydrogen potentially, which includes platinum, which is a very inexpensive material at this time. And here's another thing that I always see also in the markets here. This is what I think the conventional thought is. It says global liquidity is tightening up, yield going higher, plus rates and USD. I think once the start of the new business cycle happens, uranium miners will be exceptional. And I'm going to disagree with this statement. The reason I might disagree with this is because the beginning of that new cycle, the business cycle, I don't think is that soon. I think that we are in a expansionary phase or an inflationary phase of the business cycle, and I don't think it will end and start a new one. I think if we end the business cycle and a new one begins, that means that the inflation and expansionary phase of real estate is done. I think we can have slowing that occurs that we're seeing, but I don't think it will end and restart, because that would imply that we went into a hyper supply phase. But I don't see that happening for years. So yeah, we're having a slowdown in the middle of an expansionary phase, but I think it will continue to expand and will expand the real estate. Now, if we don't expand the real estate, you're not starting a new business cycle. A new business cycle means you go into a recession from a hyper supply phase, at least by the way that I would define it and the way the cycle's being defined. So I don't think you can start a new cycle until you hit the hyper supply phase, but I don't think we can go through the hyper supply phase because it hasn't happened yet. So uranium and oil and all these things happen during the expansionary phase of real estate. We saw it in the 70s, we saw it in the 2000s, we saw it in basically all these different cycles. Now, I don't think, by the definition of it, I don't think we're going to have a new business cycle. I think it's just the cycle slows down and then speeds back up, and we're still in an expansionary phase of real estate. That's the way that I view it. A new cycle means that you go into a hypersupply, you go back down into a recession, and then the NASDAQ and normal stocks will kick back up. So I think we're in the middle of an expansionary phase. I think we have a slowdown in it, and then eventually it's going to have to speed back up to build those homes that we're short. Now, I understand a lot of people are going to debate whether we're short homes or not, or that we're coming towards the end of this gigantic bubble in real estate. All I'm going to say is we're not in a hypersupply phase by definition because the inventory isn't there. That's all I'll say. So I don't think we're there yet. But that's all I've got for today, guys. That's what I want to share on. Hopefully you guys got a lot from the clip. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And we'll catch you guys at 5 p.m. Mountain Standard Time on Sunday if you're a platinum member for the question and answer session. I'll catch you next time. This is Finding Value.